Early on Thursday, MBS were down 14 basis points, stocks up 33 points, bonds were sideways to a hair weaker overnight, and have lost just a bit of ground due to the inflation components of the GDP report that came out this morning. These essentially suggested tomorrow's monthly PCE data should also come in a bit hot. U.S. equity futures rose as traders saw positive signs of corporate earnings reports. Contracts for the S&P 500 advanced after a two-day decline in the underlying gauge, while those with tech-heavy NASDAQ 100 extended Wednesday's rally. Jobless claims came in at 230,000 versus a 248,000 forecast. It was 246,000 previously. Continuing claims fell 3,000 to 1.858 million. We also got the quarter one GDP advance number. So this is the first reading, came in at 1.1 on a 2.0 forecast. It was 2.6 in quarter four. GDP deflator came in at 4 versus a 3.7 forecast. It was 3.9 previously. And GDP core PCE came in at 4.9 on a 4.7 forecast on 4.4 previously. GDP growth fell to 1.1% in the first quarter, according to the BEA. This is a substantial miss as the street was looking for a 2% gain. Interestingly, yesterday's Atlanta GDP now estimate was spot on, although the prior week's estimate was 2.5%. The slowdown in inventory and home building were drags on the GDP growth, while increases in income and spending were positive components. The PCE price index rose 4.2% in the first quarter compared to 3.7% in the fourth quarter. If you strip out food and energy, quarter one's PCE rose 4.9% compared to 4.4% in quarter four. Penny home sales fell 5.2% in March, according to NAR. There are 200,000 less listings now than November. 28% of homes are selling for above list price again. Today's GDP number came in lower than expected at 1.1 versus forecast of 2.1. At face value, that should be good news for rates, but bonds lost ground immediately and never made it back to the starting line. The culprit was underlying data inside the report. Fed fund futures led the charge, which are safely to be assumed by the fact that the 2-year yields rose almost twice as much as the 10-year yields. In the background, the absence of First Republic Bank failure, despite early rumors, provide fertile ground for the sell-off. At the end of the day, we were down 16 basis points on the MBS at 100.52. Stocks were up almost 80 points, and the 10-year was up at 9 basis points at 100.52. Puts us right into a real messy range in this chart, right in here, right about where the cursor is. So it's just below right between the thick red Fibonacci line at 100.758 and above the black line, which is the 50-day moving average at 100.402. So we have three ceilings on this, so we can't really expect a ton of gains, but there's a whole lot of downside to come from the data tomorrow. Politics are also on the traders' radar screens. A failure by Congress to raise the debt ceiling and prevent a default on U.S. debt would result in an economic catastrophe that would push interest rates higher or even longer. That was according to Treasury Secretary Janet Yellen, which is probably one of the few things she said recently I agree with. A default would raise the cost of borrowing in perpetuity. Future investments would be substantially more costly, so hopefully they can come to terms on that.